Welcome to Property Addicts Australia, your home for everything property investing. Get an insider's view of what really works when building a portfolio. Learn how to avoid the common mistakes, plus get all the tips and tricks from the property investing experts Sana and Mona Ali. Join us to learn from the experts and set yourself up for long-term success in property investing. Proudly powered by propertytwins.com.au.
Welcome to the Property Addicts Australia podcast. We are Sana and Mona Ali, the property twins. We are mortgage brokers and buyer's agents helping clients all over Australia build investment property portfolios. In this episode, we sit down with My Bui, Economist at AMP, to make sense of the federal budget and what the new capital gains tax and inflation indexation changes actually mean for property investors. There's been a lot of noise and misinformation about these changes. So we strip it right back to plain language. We also cover the old system versus the new one, the 50% CGT discount versus inflation indexation, and why the government is taking 47% of your gains claim isn't actually true. What it means for borrowing capacity, rents, new builds, and where prices head from here. Who the real winners are, super, shares, and structures, and how investors might rethink their strategy. Welcome to the Property Addicts Australia podcast. Today we are joined by My Bui, who's an economist at AMP. We wanted to talk about clarity around the budget and the amount of misinformation that's out there. Welcome, Me, to the Property Addicts Australia podcast.
Thanks for having me.
So, obviously it's been a busy few weeks for economists in particular, and a lot has changed. The world has changed, right, in Australia over the last fortnight. So tell us, what's your take? What's happening?
Yeah, I do agree. I think this budget is probably the most exciting budget, I would say, in about a decade. Whether you personally benefited or get hurt from it or not, you have to agree that it's the most substantial changes in a very long time compared to the previous four budgets. It was already. So I always remember budget 9, there's always a lot of excitement and commotion around it, but people forget about it the next day. But obviously with this one, it seems like you can't forget about it and it's been 2 weeks from it. So that's
memorable.
That.
It's memorable for sure.
So that's that. I think this budget, the context, I think it's good to remind what's the context of this budget. The context of this budget is that this year and next year is when the population of the millennials and the Gen Z are actually overtaking the populations of the boomers and the Gen X. So, and if you look at Jim Chalmers on Instagram over the past month or so, he's starting to do a lot more Instagram and TikToks, him making coffee in his own kitchen. I always wonder, is there an intern that lives there to actually record all these things? So you can tell that they're really trying to basically do something to show that they do something for the younger generations, for the Gen Z and the millennials. So that was kind of the context of it. It also comes at the point when I guess the age of housing investors have gone up over the years. I think part of it is actually just demographics. People actually get married later. People don't want to people have other source of investment as well, rather than just housing. People go into shares if you're young as well. But it is true that, the share of, say, 60 plus housing investors have basically tripled over the last 20 years. So there's a bit of political pressure for the government to look like they're doing something about it, and which is why they've made a lot of big tax changes over in this budget. Obviously, we are. I would guess the listeners to this podcast are mostly property investors, so the government has basically ring-fenced a lot of rules around negative gearing as well as capital change tax concessions to only new housing, not existing houses anymore. And it does seem like some other investments are caught in this little scheme as well. So shares now have a little bit less concessions around capital gains tax treatment as well.
So what was the old, can we compare old versus new system in plain language?
Yeah, totally. So obviously since 1999, when you buy an asset and you sell it, you get tax on your capital gains, on all your nominal capital gains on it. But you are taxed at your marginal tax rate, which can go up to 47%, which is very high in Australia. So the idea is that in Australia, you shouldn't really be taxed on all your nominal gains because you're basically punished because over time, asset prices always go up with inflation. So before 1999, the way you get compensated for it is that you don't get taxed on the inflationary part of your assets. You only get taxed on your real gains. But that system was quite complicated. It requires investors to keep track of inflation over the years, all that sort of stuff. So in 1999, Australia moved to a simpler system, which is that they just tax you on all your nominal gains, but they give you a 50% haircut on that to basically compensate you so that you don't get taxed on inflation. The situation has been that over the last 25 years, inflation has been a bit lower compared to growth in different assets. So that 50% discount actually overcompensates you for the inflationary gains. So now they're saying, okay, they don't want that anymore. They're going back to 1985 and they're only taxing you on your real gains instead, but you don't get that 50% discount anymore. So it creates this a bit of a complicated situation. It's a bit harder to calculate your taxes now, essentially. Your taxes, are they going to be higher or lower compared to the 50% discount scheme? It actually depends on what inflation rate is and how long you're holding the assets for. We think that for higher growth assets, essentially this means that you're taxed more over the longer term. Over the shorter term, in high inflationary environments, it's a little bit iffy. Like you can be taxed more or less, but over the longer term, which I guess a lot of property investors are at the moment, then you're essentially taxed a little bit more compared to the old scheme. And also, you cannot negative gear your rental losses against your other income anymore. So now you can only offset it against losses on other properties or against future gains. So there's a little bit more limitations on that, which essentially means that you can borrow a little bit less.
Fair bit less, though. In our experience, borrowing capacities have dropped anywhere from 20% to 30%, depending on each individual circumstances.
Yeah.
But talking about capital gains tax, apparently it's not like for like changes, right? Compared to the previous system, pre-99. Now, apparently they used to average out the indexation figures, but now it's like they're looking at each year.
I actually think the averaging out makes a lot of sense because if you think about it, for example, if you make $1 million by holding the asset for 10 years, you get taxed on your maximum marginal tax rate of 47% on your real gains. But if you make $1 million over 10 years with income, so you make $100,000 a year, essentially it's the same thing, right? But you actually tax at a much lower rate because your marginal tax rate is lower at around 30% or so. So it's quite unfair if they don't actually average it out. And I think that's one of the missing points from this budget. I think indexation is not a bad thing because I think that's the core, idea of the taxation system. They want to tax you on your real gains. And I think I'm fine with that. And arguably, again, I said the 50% discount have basically overcompensated investors for inflation over the last 25 years. But the fact that they didn't let investors average out the gains over a number of years, they only tax it on basically when you realize the asset, just means that everyone gets taxed on the maximum marginal tax rate, which kicks in a very low income in Australia. It's actually only at $190,000. It's actually very low versus, say, average income of a person in Australia is around 100K. So you make less than 2 times the average income, you already get paid the maximum marginal tax rate. And I think that is a bit of an issue. I know that, the changes haven't been passed in Parliament yet. It looks like they will be, but I think this is definitely an issue that, as a voter, as an economist, we really try to advocate for, that the gains should be actually averaged out rather than taxed at the marginal tax rate.
I think the challenging part is, say, someone sells their asset way down the track when they're no longer working or taking time off. The minimum tax rate the government will apply is 30%. So people may be penalized for waiting and selling that asset down the track.
Yeah, I agree. I agree. I think that's quite like the intention of the government in a sense, because as I've mentioned yesterday, the RBA actually released this quite interesting research about the age of housing investors, and the situation in Australia is that investors try to wait until they are taxed at a lower marginal tax rate to sell.
Yep.
Of course, like you always do that, and the government wants to cut off that. So I guess the impact of that is that maybe investors would be less enticed to, seek gains from capital gains. They would probably try to seek, returns from either dividends or rental yields more than just holding out to sell their assets. Essentially, this means that if you invest in shares, you probably want to get dividend stocks rather than growth stocks. If you invest in properties, you want to maximize your rental yields, and especially if you already have a property, and basically most of the changes are grandfathered, so you're better off, holding it for the long term, getting rental yields out of it rather than just
Absolutely. Less
selling it.
people would sell, and obviously there is a massive shortage of houses in this country. If there's not that many properties coming on the market for sale, then
Mm.
it may put upward pressure on values still.
Yeah, I think that, yeah, I mean, it is a bit hard to see the impact in the short term and the long term. I think in the short term in Australia, obviously, we all know that there's a little bit of a downturn, especially in cities like Sydney and Melbourne, which are a little bit more cyclical. And part of that is from the rate hikes this year as well. I think that, over the short term, investors tend to be marginal buyers of the market. And there's now less investors in the property markets, which mean that prices might actually, soften further a little bit in Australia. That's over the short term. Over the long term, you're right that, the ultimate driver of prices in Australia are supply and demand. And we've already had a bit of a shortage of housing, not a bit, actually quite a bit of shortage of housing in Australia, which we estimate at around 200,000 dwelling units. That will still be the fundamental drivers of market in the long term, and we still see upward pressures in housing prices over the longer term. I guess the government intention is that because a lot of the tax concessions are preserved for new housing, they want investors, if you have investment, they want investors to invest in new housing a little bit more rather than existing housing. And actually, I want to make a point about this as well, is that a lot of the tax changes are not impacting SMSFs or self-managed super funds, or superannuation in general. So there might be a bit of an uptick in investors using SMSFs as an investment vehicle. If you want to go into the property markets, the tax concessions there are still quite generous. So ultimately, maybe like financial advisors and accountants actually benefit out of this because they need more advice.
So, whilst investors will now focus on higher yields, or the yields may go up, rental yields may go up over a period of time, and the government's actually indicated only $2 a week
Mm.
impact of these changes. What's your view
Mm.
on that?
I think it is true that over the short term, rental prices would actually go up. I think that, yeah, so like simply this is, as you mentioned, is simply just supply and demand, right? There's basically less investors in the existing markets. And basically the government wants to have more buyers being first home buyers, but than investors. So there's investors going to the market. So there's basically less existing rentals, and that pushes up prices. Another way this can work is that now that investors don't get a lot of the tax concessions anymore, for example, the negative gearing against their income. So what do? They basically demand higher yields on their investments to compensate for that. And that means they demand higher rents. So over the short term, I think rents would definitely go up. If we look at short-term rents, according to SQM, I love looking at this, they have advertised rents. They're still quite trending up, even though the inflation data in Australia shows that rental prices were softening over the last few months. So I think there's no doubt that, over the short term, rental prices would have to go up. Over the longer term, though, the government says that rental prices can go down with more housing investments. But I think that, well, we never know. We still have to look at
$2. We've been told it will increase by $2 a week.
over the longer term. I think that, there might be some downward pressures given that there's more investment in housing in Australia. But again, it is a longer term story, and I guess over the short term, it is true that renters will suffer a little bit. Over the longer term, I think, when you want to look at rents, you just have to look up basically how much we're building, how much building completions there are in Australia versus the number of population growth in Australia, which is ranging at around 1.5, 1.6% every single year. Meanwhile, completions have actually slumped a little bit over the past few months, I would say. We're only building around 170,000 dwelling units per year versus a need, I would say, at around 240K per year.
Question.
So, yeah, sorry, you go.
Or a thought. I know we said the government wants to increase first home buyers to have a greater chance, right, at acquiring their homes. But the problem is investors who can no longer afford those more expensive investment properties will now target this lower end of the market, end up competing with those first home buyers, and again, pushing up the prices for those dwellings as well. So it defeats the purpose.
I'm not sure about that, actually. I think that, in first home buyers still have a lot of edge in this market still, just given that, again, it's less attractive for investors to go in. And also there are actually a lot of concessions in terms of like deposit size for first home buyers as well. So I do think that, first home buyers would actually increase as the share of the market. Again, as I've mentioned, like markets are down a little bit, so like total number of buys in the market would go down, but the share of first home buyer would go up. We've actually talked about this. So the government actually estimates that there would be about 75,000 new home buyers going into the market over the next 10 years as a result of the tax changes. I think that's a positive thing. I mean, it is a good thing that there are more first home buyers, but we also need to think that, the impact size is actually quite small. Every single year, there are around 115,000 new first home buyers in the Australian markets. So that's 75,000 over the next 10 years only accounts for 6% increase in the annual growth of the market. So again, like as an economist, I still think that it is a good thing. It is a good thing that, there are more first home buyers in the market, but it is it is not a huge impact.
So, though these people, they may be renting right now, these first home buyers, and we are saying rents may increase in the short term. So there's less deposit left over for these people, really, or less deposit that they can save up, or it will take longer for them to save up a deposit.
A little bit, I would say, but at the same time, when you have prices going down, so the size of the deposit that you need goes down a little bit. Again, like I think, yes, like it will still be a challenging market, especially for investors. Like that's no doubt. But I think for first home buyers, there's kind of mixed over the next coming year, I would say. For us at AMP, we think that there might be a bit of a dip in the short-term market of around 5%. That might actually help with the deposit size a little bit. Over the longer term, though, I think next year we might still see a 3% rise in home prices in Australia. And over the next years afterwards, I would say that, prices growth on a national level will still remain around 3 to 5%, which is actually a pretty conservative forecast versus the past few years, I would say. Another piece to the first home buyer deposit, I think, is also wages growth in Australia. It's ranging at around 3.5% right now at the moment. So if wages growth can keep up with that pace in price growth, then first home buyers or like most, income earners would benefit. So that's kind of another piece to the puzzle as well, which there are a lot of little inputs in it. Wages growth in Australia would probably go up a little bit in the near term, given that, the minimum wage is actually going up in Australia. We actually get a decision next month from the Fair Work Commissions. But over the longer term, the actual drivers of wages has to be productivity. And on that, I'm actually a little bit more negative because productivity has been a bit stagnant here in Australia. So yeah, I mean, again, there are both good and bad. I know that like I sound a little bit like, oh, there's black, there's white. I got both sides, but that's kind of the reality. There are a lot of, headwinds for first home buyers as well as tailwinds, really.
Well, productivity has been really low in Australia, and there is talk that productivity property will be impacted even further with the changes the government has made. And, these are massive changes, right? They're not small changes. It's just changes the way Australians invest moving forward, the amount of risk they're willing to take. So it would be interesting to see what impact it has, whether it worsens.
Yeah, I actually think that, the government is actually starting on the right path to reform productivity. Again, as I've mentioned, it is true that arguably investors have been overcompensated for the inflationary gains over the last 25 years. And a lot of property investors might be more enticed to invest in shares, which I think is a good thing in Australia because, ultimately you want more investment in productive shares. On the other hand, I think you're right. Like some startups might be caught up a little bit in these changes because I guess, essentially over long term, it is a bit of a tax hike in Australia. So there might be a bit less investment in venture capitals or startups. But then again, the government also says that they are still consulting with startups and tech sector on this. I mean, again, and over a long term, I don't think that the tax changes hurt productivity, essentially. But I think the government needs to do more. They have started to do some stuff related to deregulation in Australia, according to the budgets, but it seems to be quite marginal changes. I think in Australia, the fundamental problems here is that our top marginal tax rate is still quite high. It is a disincentive to work. It is a disincentive to innovate or for, risky investments to be made here in Australia. I think ultimately they really have to cut the maximum income tax rates to basically entice talents to come here and invest and boost up that productivity story. But again, it is a long-term story. Hopefully they do something next budget, maybe election
possibly
budget.
next budget before the election, they might drop tax rates. Then, I guess,
or they might introduce taxes on owner-occupied homes.
Oh, that's another thing, right? Owner-occupied homes, we don't know what they would do with super. I know currently super regulations haven't changed, and that may encourage many people to focus on that. Possibly make more super contributions and buy a property through super. But I guess talking about property generally, I know negative gearing's gone, impacting 20 to 30% in borrowing capacities. There are ways around it. If rents are going to potentially rise in the short term, as you said, and should tax rates come down, then perhaps there might be some sort of a balance in the negative cash flow investors would incur. So they just have to work with the rules set.
But APRA might step in and force lenders to shade rents even more.
Yeah, I mean, I think over the last 2 years, what we've seen in Australia is that the share of investor lending has gone up a lot more relative to owner-occupiers in Australia. Remember, a few months ago, APRA tried to kind of curtail this a little bit. And I do see this in the same kind of momentum, I would say. They probably just want to do a little bit more to curtail that growth in investor growth in terms of in terms of lending commitments from banks. Yes, I do agree. I think a lot of big banks have already moved to basically cut off, assessment for investors' borrowing capacity because there's a bit less tax concessions on it. You basically essentially pay a little bit more tax. I mean, it is hard to see that, the investors coming back over the next coming months in Australia. Over the longer term, I still think that the Australian property market is a good place to invest, just because, as we mentioned, we have a structural long-term issue in undersupply. Yes, there will be less tax concessions, but ultimately, ultimately over the long term, you want your property to be positively geared, right? The negative gearing is only in the short term.
Absolutely, it's a timing issue, right? So, so perhaps this could be a good window for someone wanting to do something when there's less competition, perhaps get in the market, benefit from short-term rent rises that will help neutralize some of the negative gearing loss, or perhaps make up for it. But it may make up for it, right? There is a chance to say if a property is costing $20,000 a year before tax and your average tax rate is 30%, so you get $6,000 from the government to fund that,
Mhm.
perhaps rents may rise over $6,000 over the next few years, which may help, reduce that gap eventually
Mhm.
anyway.
Mm. Yeah, I agree. And actually, I think investors also should remember that you still can carry forward the losses over the longer term, or say, if you have a portfolio of more than two properties, yes, you cannot offset it against your other income, your pay-go income, but you can offset it against your other properties if you have a positively and a negatively year on, for example.
So it's good for existing investors who already may have at least one or two investment properties, because if their
Yeah.
rents are going to rise and they buy a negative cash flow property, that pretty much offsets that. So
Yeah.
I think existing investors will be okay. It's just the issue is with first-time property investors who are looking to get in the market and they do
Yes.
not have that extra bit of cash flow coming in or extra bit of upside.
Yeah, I totally agree with you. I think that's totally right. I think that is basically the mechanism why there's a bit less existing homes on the market as well, just because you don't have that new flow of property investors coming in. But yeah, if you're an existing investor, good luck, because you actually do have quite a lot of tax concessions. I think that's also the reason why I think personally, I think it will be actually quite slow to see the actual average tax rate in Australia going up because of these changes, because all the existing are grandfathered, right? And people would probably try to hold on to their properties a bit
Oh,
more.
absolutely. It might, if anything, it might impact the supply available. People who were planning to sell might say, okay, I don't really have an incentive to sell. I'll just benefit from the future gains, pay off this property, keep it long term.
Yeah.
So perhaps it may impact supply even more.
Existing supply, a little bit, yeah.
Yeah, for existing properties, exactly. As
Yeah.
for brand new, depends where these brand new properties are located. Yeah, sure, there is negative gearing benefit, but is
Yeah.
there any resale value with these brand new properties? Because they become secondhand after, right? They become established once someone's owned it. You would have a smaller pool of buyers to sell that property to. So
It's a second-hand car.
yeah, like a secondhand car, exactly.
I guess if investors want to invest in new housing at the moment, it's probably mostly for rental yields rather than for capital growth.
For tax benefits, and that's what many spruikers will be flogging, really, the tax benefits. But I'm curious though, me,
Yeah.
when people assume that everyone's investing for tax reasons, but that's not the case, right? When Mona and I started our journey, Sydney was at all-time lows, like 2009. I mean, there was a small increase with first home buyer incentives at the time.
Yeah.
But our goal was always to buy properties that would eventually pay themselves off. We didn't even think the markets will grow. We never expected the markets to grow because the headlines were always that Sydney was going to crash. So there's a big assumption that a lot of investors are investing for tax reasons. But the truth is, we've had thousands of phone conversations with potential clients, and most of them, the goal is financial security, stability, control, planning for their retirement. Some, yes, do say, I want to reduce my tax, but that's never really the key for them to invest.
I totally agree with you, Sana. And I think that's the core reason why I think that, people shouldn't really freak out too much about these tax. Yes, they are tax highs. But I think ultimately, again, as we've mentioned, the fundamental drivers of the market is supply and demand, and we do have a shortage of supply in Australia. So yes, you pay a little bit more tax over the short term, maybe like when you sell for the long term in your retirements. Yes. But ultimately, the question that investors need to ask when they invest is, are these good investments or not? You pay tax because you actually make gains on the investment, not because you make losses, right? So, and ultimately you want to make gains on your investment. And we can again debate to death about all of these marginal changes to taxes, but I think the fundamental mental question for investors should be, am I buying this because it represents good rental growth, or it represents, because it's underloved and undervalued in this market, for example. We've had this conversation about how Melbourne has been quite underloved because of all the tax, of all the land tax issues in Victoria. And I think, it is a bit of an issue. But when, no one's looking at it, that tends to be when a property is undervalued and underloved. And as an investor, you should be looking at those things.
They say that you should buy when you're feeling the most uncomfortable, really, and you don't particularly like a market.
no, and people feel comfortable when the market's heated and it's booming and they feel more confident. I think that's a higher risk because the risk to reward ratio is much lower in comparison to buying in an area
Mm.
or a location like Melbourne, where people have been hating on it for a very long time and they talk all negative about it because there's a lot more upside with that. There's more, you may be taking more risk based on what you see in the media, but there may be a higher reward to go with it.
But Mona, also, I think we were discussing that it seems like also it feels as though the government wants to reward bad investments.
That was my take of the capital gains tax calculation. So, yeah.
Yes, I mean, it's true that for higher growth, you pay more tax, but I don't think you should think of it as a punishment. I don't think investors should think of it that way because, again, you pay more tax because you make more gains. Yes, you pay more tax. And I totally agree with you guys that over the long term, it is a tax hike. And this is not true tax reform by the government. True tax reform should mean that, income tax rate should be dropped. You shouldn't actually tax like people, the highest marginal tax rate are just 190K. But again, you pay a bit more tax because you actually do make quite a lot of gains. And I think that yes, over the last 25 years, we've had pretty good tax treatments in Australia. It is a bit annoying that now you have to pay a little bit more on it. But that just means that maybe now that investors just need to be a bit sharper. You just need to be a bit more careful with like where you go into the market. You just as you said, like you don't actually go in with a crowd with FOMO, basically.
Well, I think the growth that we've had specifically over the last 6 years, right, since COVID came about, has been very different to what we saw, when we were building our portfolio, anywhere from 2009 to 2013, the properties we bought, they weren't really necessarily going up in value, week on week, unlike what we've seen in the last six years or so. So perhaps growth will normalize and market was on an easy mode the last 6 years. So it's not necessarily a bad thing. And I'm not so much concerned about capital gains tax. I'm more concerned about borrowing capacities and how they have shrunk and people who genuinely need to go ahead, like, our client base who are corporate professionals and their young families. And if they're starting out with their first investment property, I think it will really hold some of those people back. But as you said, fundamentals don't change. So people, like if they did take action now, there will be some rewards. There might be some rental yield down the track. So people should not make all their decisions just purely based on tax. And Sana and I have seen times when properties weren't growing to the same
They
degree.
did nothing.
Whereas
Not much.
many of our clients who have built portfolios over the last 6 years have seen so much growth. Maybe they think that that's just the norm. That's an easy way, really. It's not meant to be like that, or it was never like that historically in our experience.
Yeah, I totally agree as well. And I think I actually remember, when we were looking at these tax changes, we mentioned that in 1985 we had inflation indexation as well. And actually back then, house prices were still going up as well, but just at a lower rate versus inflation. So back then, anyway, since 1999 until now, average annual home price growth in Australia was around 6%-ish. 1985 to 1999, guess what it was? It's actually 5.8%. So it's lower, but not that much lower.
It's almost the same, really. It's
yeah, so
5.86.
it's definitely lower, but not that much. So, and back then inflation was a little bit higher, which I would say seems to be quite similar to the current environment. Like right now, inflation is quite high. So you might see a little bit of moderation in price growth, but ultimately, I think our long-term view is that, again, if the government doesn't really change the speed of like approving new housing, we still have a tradie shortage in Australia. We still have a shortage in labor and construction. I mean, if you've done renovation in the last 2 years, you probably would know this. It's so annoying to call up tradies to get things done. Like if those things are not fixed, then the supply would still be quite constrained and basically prices will still appreciate in Australia.
But obviously it's all at once, right? The rates have increased. We've had 3 rate rises this year.
And
There might be one more.
yeah, well, that's my next question, right? Coupled with these budget changes, which have already impacted borrowing capacity, do you see another rate increase?
So the central bank doesn't necessarily look at housing, as one of their targets. Yes, they do look at it because there's a little bit of a wealth impact. So say, for example, if house prices drop so much, people don't feel as wealthy, they wouldn't go out to spend as much. But ultimately, what do they try to look at is a balance between inflation and the labor market in Australia. The labor market in Australia actually remains quite okay. We've had a bit of an increase in the unemployment rate to 4.5%. From last year, it ranged between 4.1 to 4.3. But compared to most of history, we're still doing very good. Before COVID, we had something like 5 to 6%. So right now, they're not too worried about that. In terms of inflation, so we just talked about this right before the podcast. It really depends on when Hormuz opens, and no one really knows when it opens. Right now, it does seem like Iran is basically holding the ball on the court here, and they have a lot of control. And
Even
right
in
now,
Australia, it impacts us all the way in Australia.
it does because, well, we import basically 80 to 90% of our petroleum needs from Asia, and most of those use crude oil from the Middle East. And right now, global oil supply is down about 13% versus February. So there's a little bit of a constraint here. We don't really feel it yet in Australia, I think, because one, we are a rich country. We actually have LNG, so we have leverage to actually buy more fuel, whereas a lot of countries in Asia are actually experiencing the shortage already. We also have had a bit of a cut in the fuel excise worth about 26% a liter. So we don't feel it yet, but the inflation pressures are there. Headline inflation is above 4%. Trimmed mean inflation is 3.4, which is way too high versus the RBA target of 2.5. So going back to the RBA, that's what they're looking at. They're looking at whether, new dwelling costs are going up in Australia, which it has been going up quite quickly because of that labor and shady shortage. We're potentially seeing some increases in food prices, given that there's a bit of shortage in fertilizer here in Australia, which ultimately comes from the Middle East as well, which is being strained at the moment. So I think our view, as well as the market's view, is that the risk tilts towards another rate hike in Australia, potentially in August. I think that's still up in the air. It's definitely not a done deal. If consumer spending slows quite a bit, which it has started to slow in April, if that momentum in slowing is a bit more pronounced over the next 2 months, then I think they can hold tight. But if the inflation numbers keeps getting worse and Hormuz is still not open by then, I think we have to see another rate hike in Australia. The comforting thing to hear here is that the RBA already admitted that their rates are already restrictive to markets at the moment. They already said that, so they know that they are restrictive. So I don't think they will move in June in the next 2 months.
And I guess for our audience who are property investors and are borrowing money, when do we expect a rate cut cycle to arrive? Or is it even on the horizon?
I'm trying to get my crystal ball to see this here. So our house view is that we might actually see a rate cut in the second half of next year in Australia. Again, the RBA, as we've mentioned, they admitted that rates are already restrictive. So they basically say that there has to be a rate cut at some point in the future. The question is just when, because again, we're above the balance rate here. We think that activities would slow, towards the second half of this year. GDP growth will slow to around 1.6% by the end of this year. That would make the central bank a little bit more concerned going into 2027. And we might actually see 2 rate cuts in the second half of next year.
But still, we're looking at least 12 months plus, really, before much relief, really.
Yeah. I think it will probably be a bit tough for both investors as well as households in Australia over the next coming months. You guys probably know this, every single rate hike adds to about $100 to $120 to monthly payments to the average mortgage in Australia. So, over the last three hikes, we've already added around $360 a month to payment for the average 600 to 700K mortgage in Australia, which is quite a pretty sizable chunk of your budgets going out there. That's not even including the extra amount you have to spend now on food and on fuel as well.
Yeah,
So
but
yeah.
would we ever see rates and market booms like we had in the early 2020s?
Oh, I think it will be quite hard to see that happen because I think back then there will be that was basically, the best it can get as an investor because you have lower rates. You also have government stimulus, being handed out in the economy. Um, so both fiscal and monetary policy are actually adding to that growth. From now on, I think it's harder to see rates going down to that low as back in COVID because we are entering a world of that's more inflation prone. We have more geopolitical risks. We have more supply chain disruptions. So it is hard to see the central bank, going back to that zero rate environment as we have seen. We think that the neutral rate in Australia would remain around 3.5% to 4%. It will be lower than now for sure. I think rates are quite restrictive, but it won't be as low as in even the 2010s. And I think that just means that going back to our audience as property investors, it just means that you have to be sharper. You can't just buy everything that you see on the market. You can't just have FOMO. You just have to distinct the fundamentals and the quality.
Yeah, so it's not like a dartboard approach, and over the last few years or last number of years, people have just bought anywhere and everywhere, and prices have gone up. Sorry, Melbourne aside, sorry, Victoria
Sorry, Noah.
aside. In terms of other locations, people have bought in multiple locations, and prices have just continued rising.
Well, the
Yeah.
pullback that you touched on, the market will pull back. Like, what percentage are AMP suggesting it might be the drop?
I think, again, we've mentioned that every single market is different, and Melbourne probably has a bit of a COVID hangover here. So Melbourne probably sees a bit worse results. But I think on a national level, on a national average level, we probably would see a 5% dip this year before rebounding again. Again, it's a temporary dip. Things will be tough over the next 12 months, but I do think markets can actually recover at a pace of around 3% next year and maybe 5% the year after, especially if we have the rate cuts. Of course, I think there's still a little bit of juice to come from, the booming cities of Adelaide, Brisbane, and Perth. Remember that Perth has actually been underperforming throughout the 2010s in Australia.
10 years.
Yeah, so they're basically recovering their gains, and I think that there actually might be a bit more to go in those markets. Meanwhile, Sydney and Melbourne are probably seeing a bit more pronounced declines, especially in the upper segment of the markets, over the next coming months.
So 5% drop might be averaging out all of Australia, right? But then based on our experience, the lower end of the markets are getting more interest because of borrowing capacity is being impacted.
And also because first home buyers can get that 5% deposit, so they also try to go in there.
That and plus investors who've, they've had their borrowing capacities impacted. There's no, like, they can no longer afford to, hypothetically, someone who was looking to buy an 800K property now, they can only do $600,000. So they have to tweak their strategy, and that's what we've been working on with many of our clients. And for most people, it's business as usual with a tweaked strategy. It's a handful of people we've seen. They've said, no, we don't want to do anything, but most people are still going ahead and with their life plans, really.
Yeah. So that goes back to our point, right? Like, we can debate to death about taxes, but ultimately it's about the fundamentals.
Fundamentals and people's desire, in our experience, of security, stability, control, and potentially financial freedom down the track.
Yeah, I agree.
Any parting thoughts, to our audience?
Yeah, so I guess I just want to sum up, our thoughts about all of these changes. I know they're very substantial. I think that, again, I'm using my economist voice again, and I think there are definitely both good and bad coming out of this budget. The good thing is that I think the government is showing that they have the appetite to do some sort of tax reform. Again, remember in 2019, a lot of these changes seems untouchable to them, but now they seems like, wow, they're willing to do it because they have the political capital. It's also good to see that there are quite a few spending cuts in the budgets. I know that they're quite backloaded to the later years, but I think some spending cuts from the government is quite good. That being said, I think the government can definitely do a lot more, as we've mentioned at the beginning of the podcast. I really wish that they could actually let investors as well, most investors average out their capital gains over the years, because I think that's a much fairer system compared to what we have now, where investors are pushed into the top tax brackets. I wish that they would actually reform those tax brackets as well, because we're quite highly reliant on individuals' income tax here in Australia. Basically, double the amount of the OECD average, with very high marginal tax rate kicking in at a very low multiple. That has to come with maybe raising taxes in other areas, such as consumption tax, for example, which is quite hard to do. But I wish that the government could do that in terms when they have the political capital. And then finally, I think, especially relevant for housing investors, I really wish that the government could do a little bit more in terms of deregulation as well. I hope that I know that immigration is a big issue in Australia, but we actually do need more tradies here. So I wish that they could actually calibrate the immigration intake to maybe have more construction workers here in Australia. I wish that a lot of new build projects actually push through a little bit faster across different states, because ultimately that's actually the solution to solving the supply and demand imbalance here of housing in Australia.
And until the supply is not provided, until the supply comes on the market, we will still potentially continue seeing impact on existing housing, an increase in values perhaps, and rentals.
Yeah, over the long term, yes.
Well, thank you so much, Mi. It's been wonderful having you on Property Addicts Australia today.
Thank you, Sana and Mona, for having me.
Thank you.
A huge thank you to My Bui from AMP, cutting through the noise and helping us make sense of the budget. If you found this episode helpful, share it with fellow investors and leave us a review. Thanks for listening. Join us next time for another episode of Property Addicts Australia podcast.
Thanks for listening to Property Addicts Australia. For future episodes, click follow. Leaving a review helps others find the podcast. And for more information about how we can help you, visit propertytwins.com.au.